Hi everyone, welcome back to the US taxation classes for CPA. In this particular video of regulation exam, we'll be covering in detail about asset basis and holding period of asset, where we'll be covering what is the basis of asset, how to calculate the basis of asset when you have standard purchase, when you have group purchase, when you have bargain purchase, or when you have inherited the properties, or when you receive the property as gift, right? In addition to that, we'll be covering when we are converting the personal property into the income production property, and lastly we'll do some practice question. So let's dive into to understand more in detail about asset basis and holding period of asset. So let's dive into the fixed assets, property, plant, equipment, capital gain, and all those transactions which we were discussing. So before we went on a break, like we have already discussed few good important topic, which is like type of properties, capital assets, and then we discuss about division of the property and the capital gain and ordinary gain, which is part of your regulation examination. Now we are jumping onto the asset base and holding period. So asset base, like holding period, as its name suggests, is how many months or how much period you have hold any particular asset, right? So basis on the holding period, basically like nature of gain or loss is being decided, right? So if you are holding any asset, so listen carefully. Here is the difference. So if you are holding any asset for less than 12 months, it will result into short-term capital gain or loss. If you are holding an asset for more than 12 months, it will result into long-term capital gain or loss. Clear? Whereas in India, like many of you have studied the taxes, you might have experienced for investment, the period is 3 years. Whereas in US, the period is uniform, right? That is 12 month. Before 12 month, it is short term. After 12 month, it is long term. So that is why we'll be understanding the holding period. Now coming to the asset basis. Asset basis is the value of asset, right? The value of asset at different stages would be different. For example, when you are purchasing an asset, right? So when you are purchasing an asset, so what all things need to be included in the cost of asset? Can any one of you explain me? Any one of you would like to share what is to be included in the cost of asset when you are purchasing any new asset? Are you guys here?
Installation cost.
What else? So when you are purchasing an asset, so what all things you will be paying? One is the cost of asset, right?
Yes.
Second, that asset transit cost like freights,
Yeah.
inward, right? Second, maybe like insurance during the transit, right? Third could be like installation cost, right? Fourth could be any, like implementation of new software or any capital improvement in that, right? So those all costs club together, and once it is being ready or put to use, you can capitalize that. So that is the cost when you are purchasing the new asset. And then after, let's assume after 1 year or 2 year, what will be the basis of asset? Basis of asset is, that means original cost which you have capitalized minus the depreciation you have charged so far, right? The accumulated depreciation on that particular asset will result into the basis of asset at any particular point of time, right? And maybe like after 2 year, 3 year, 4 year, 5 year, if you have done any capital improvement, right? So that capital improvement cost, which we were discussing earlier, the capex item, that will also be added to the basis of asset. right? Clear everyone? So that is called asset basis. So at different point of time, the assets basis will be different, right? So first you need to understand the situation at which the asset is being there. If it is a newly purchased asset, then the payment you are making or insurance, freight inward, right, installation cost, that will be the value of asset. If the question is saying the basis of asset after 2 year or 3 year, that means original cost minus the respective year depreciation will be your basis of asset. If the question says after few year any capital improvement has been done, so you'll be adding the respective capital improvement cost, right? Yes, Shambhu.
Sir, actually, I have one question.
Mhm.
Since basis of asset, we are talking about the capital assets, right?
Mhm.
For basis of it. So why are we deducting the depreciation, depletion, amortization here? Because
Mhm.
in the definition of capital assets, we have excluded the depreciable property which is used in the ordinary business.
No, we have not excluded. We have never said it is excluded. We said there are two type of property, which is real property or personal property. So we have not said like these all are business property only.
So, but capital gain or loss would be calculated on the capital assets, right? But these real
Mhm.
property and personal property are business properties.
Yes, these all are business property. Real property is land or anything permanently attached to land. Personal property is other than real property used for business purpose in a short form, I say.
So when we will be selling the real property or any other personal property, there won't be any capital gain loss, or
Yes, there
it will
will
be
be.
considered as there
There
will be
will be.
capital gain loss.
Yes, because it is a capital asset. So when you are selling capital asset, it will result into either a capital gain or a capital loss. But how you need to calculate that gain or loss, for that you need a value, right? So what is your cost? What is the basis of asset at the time of sale? That is the reason we are understanding basis of asset.
Okay, I think so that this is something different from Indian laws, which is
Mhm.
there.
Mhm.
So.
Mhm.
Uh, we don't
Now you got,
usually calculate.
yeah, now you
Yeah,
got the
also
clarity.
there,
Mhm.
yeah, also there, can you go a little down on this page where there is a definition of capital assets?
Mhm. Mhm.
This one. So all properties except this second point, depreciable property or real property used in trade or business, these are not capital assets, right?
No, that
So,
is section 1231. So that I said we'll be discussing four sections together: 1231, 1245, 1250 and 291. So these are the four sections we'll be discussing separately together. So
uh,
I'll show you once again. There is a separate table to deal with these four section. So which probably in the next class we'll be covering. That is
Sir,
slightly.
sorry to interrupt a little small question, although it's
Mm-hmm.
not relevant here, but still you are referring in 1231. So in
Yes.
India, I'm not mixing up India with the US, but I want to understand. In India, we understand 12 subsection 31 or clause 31 like that. But here it is given 1231 and you are reading 1231. Is 1231 or 1231?
No, this is how they pronounce. It's 1231.
So
So
we have
there
to
would be
learn the first two numbers.
no. Let me complete.
Yeah, sure, please.
So how they are pronouncing the section of the law. So the same way I'll be pronouncing one. Second thing, like we use, you can say rupees, or we use the terminology lakhs. So, but in US, everything we will be discussing, one in terms of dollar. Second, the terminology we'll be using is thousands, millions, or billions. We'll not be using lakhs. And 1231 is 1231. So in a short, they call it 1231. So this is one section. which
Okay.
is 1,231. Clear, Manoj?
Yeah, sir. Yeah. So it let's suppose there is a 1, 2, 3, 1, 5. Then they will call it what?
1245.
No.
Right. Say
And total
this
number is
is
1, 2, 3, 1, 5. Number is 5 digit.
1 second. 1 second. So 1, 2,
3, 1, 5.
3, 1, 5. So it will
Yeah.
be yeah, 12,315. Yeah.
Okay.
Hmm.
Got it.
Mhm. Yeah, Shambhu, what's your question?
So, sir, I was saying like 1231 is for calculating the ordinary gain or loss,
Hmm.
right? So in case of real property or personal property, there will always be a ordinary gain or loss, isn't it?
Yeah, under section 1231 category of asset. Yes.
Okay, so assets, so real properties or personal properties which are not depreciable would have the capital gain or loss, and those which are depreciable will be calculated under 1231 under
Yes.
ordinary gain. Okay,
No,
sir.
no. You should not say under ordinary gain or loss, but
Oh, yeah,
consider as per section 1231.
T1. Right,
Right?
right,
In
right, right, right.
1231, there would be again two legs. Some part will go to
Hmm.
ordinary income, some part will go to capital gain. So we'll come to that. So that probably tomorrow we'll reach to that stage.
Okay, sir. Okay, got it.
Hmm.
Thank you.
Yeah. Once again, let me come back. So coming back to the basis of asset. One second. Yeah. So basis of asset is the terminology which they use. We call it, like written down value of asset or the cost of asset, right? So I think in last class also we discussed in India, we use two method of depreciation majorly. What are those? In
SLM
India,
WDD.
yeah. So first you need to unlearn, right? You need to unlearn those methods because those methods are not applicable in US tax law. So you will be learning the new method, which is MECAR and alternative depreciation method, right? So same way, the new terminology you need to relearn. So some of the terminology, for example, in India, we call it cost or we call it WDV value, right? But in US, the single term is used, basis of assets. So basis of asset can be at the time of purchase or can be after some years, can be after some capital improvement. So the terminology commonly they'll be using is the basis of asset. Make sense? Clear everyone? Yes, no, kuch to bol do. At least give me a thumbs up if you understood.
Yes.
So the first thing is original basis of asset. That is any amount you have paid to purchase the asset plus if you have purchased any asset and for the vendor whom you have taken the asset and you have discharged their debt, right? Or any other obligation. So that is also being considered as purchase consideration paid. For example, I have a machinery. The value of the machinery, fair market value of the machinery is $1 million, right? And I have taken a loan of $500,000 on that machinery, right? Now, I'm not using that machinery and you want to purchase that machinery, right? So we make a deal that you pay me $500,000 and you repay the remaining $500,000 loan, right? So you are paying cash $500,000 plus you are discharging my obligation of $500,000. So for you, the value of asset is $1 million. Make sense? Clear everyone? Plus any title fees, legal fee, transfer expense, insurance expense, which is like at the time of transfer you will be paying, right? Or any other amount seller onto the taxpayer and they both have agreed to pay. So all these things will result into your original basis of asset. Plus, if there is any capital addition like installation, any improvement, right? Any property tax, any mortgage interest, any unproductive real property may be capitalized at the election of taxpayer. So those all things need to be added, minus if there is any cost recovery. So to the depreciation, depletion and amortization, right? Mark the word depreciation, depletion and amortization. In US, they use terminology cost recoveries. What they call it? Cost recoveries. So cost recovery is a common term used for depreciation, depletion, amortization, right? So all those things you will be reducing and that will give you adjusted basis. So these are the terminology more frequently you will be experiencing in question and answer. The first one is basis of asset. Second is original basis of asset. Third one is adjusted basis of asset, right? So all these terms will be coming based on which status that asset is belong to. Clear?
So
Right?
it
Any
means
doubt?
basis of asset is equivalent to cost of acquisition.
Yes.
Like
No.
that.
No. Again, I'm telling you, basis of asset is more or less you will see interchangeable. But when it says original basis, then it is at the time of purchase. When it says adjusted basis, it is after depreciation, depletion or amortization. Basis of asset at any point of time that respective asset is. Right? That you need to understand
Okay, so
and correlate from the other line of the questions.
okay, so matlab, original basis is the cost of acquisition, capital addition is the cost of improvement, and what is the last one? Additional basis
Capital
could be something.
recoveries. Capital
It
recovery
could be
is,
something else. Yeah.
that is your depreciation, depletion and amortization.
Okay.
Right? Next is basis of property acquisition depend primarily on the method by which the property was acquired. So basis of property is depend on the basis at which you have acquired the property, right? First, if you have done standard purchase, that means you have purchased any asset. So whatever the cost you have paid, that is your basis of asset. Second, if you have done any group purchases, right? So if there is bundle of assets and you have paid one money for that, right? So then you need to do allocation of the cost to individual asset at their fair market value, right? So have you understood or do you want me to add any example? Clear? Third one
And
is,
so what? And so
yes,
what if the cost cannot be allocated on individual assets?
say that again, Shambhu.
I was saying, what if the cost is not allocated on the individual basis?
Yeah, so for the cost allocation, there are three methods. So yes, very good point. It's not part of your examination, but otherwise just for your information. First is you can say, I would say the fair market value of that asset, which is like, for example, let's assume you have done a lump sum purchase. Have you heard this term? Lump sum purchase?
Yes. Yes.
Right? For example, you are purchasing the assets of any particular company in a lump sum. So in that, let's assume you got 10 laptop, you got 5 computer system, and you got 15 chairs and 15 table. And let's assume you have paid a lump sum $100,000 for that, right? And now, for example, the laptop which you have has the fair market value of, let's assume, $2,000 each, right? And the
Okay.
computers which you have taken, let's assume, has the fair market value of $3,000 each, right? right? And then for chair and table, right? Let's assume you do not have fair market value, right? So it is like, let's
Right.
assume handmade chairs or handmade table, or maybe some antique chair or antique table for which you may not have fair market value available, right? In that case of scenario, what you will be doing is the fair market value available for laptop, which is $2,000 multiplied by 10, $20,000, right? Fair market value of the computer, $3,000 multiplied by 5, $15,000. That $35,000 will be allocated to respective computers and respective laptop. Now the remaining value will be allocated on the similar kind of assets value in the market, the chair and table. So for example, if you do not know the 100% fair value, but there might be similar category of assets available in the market. So what is the fair market value of those similar asset? Basis on that, you will be doing allocation of the remaining value to the remaining chair and tables. Make sense?
Understood. Yes, sir.
So that is called
Yes, sir.
cost allocation method. Next is very similar, bargain purchase. So bargain purchase is cost minus bargain gain. So the fair market value at the date of bargain purchase is your bargain gain. So bargain gain is basically, for example, let's assume there is a Apple mobile phone, right? We all know the new mobile phone has value of $1,000, right? Every year in 14th or 17th October, they launch it. The new Apple iPhone is generally have $1,000 or $11,000 based on the size. Normally the differences, right? For example, I purchased a new mobile for $1,000, which is iPhone 15 Pro, right? Not the Max one, right? Now, after immediate that, I am in urgent need of money, right? I came and reached out to you. I have purchased this mobile and this is like the valid bill from the Apple store, but I am in a need of money. Would you like to purchase that? Right? And then you have done some bargaining with me because I'm in need of money. You said I can maximum pay you $700, right? So here the bargain gain is $300, right? Even though at the bill there is a cost of $1,000, but you have actually paid me $700. So the value of asset in your book should be $700, despite of the fact the bill is of $1,000 and you have paid me $700. Make sense? Next one is very important, is inherited property. So what is inherited property? Any idea?
Which we got from our ancestors.
Yeah. So when someone inherit the property from descendant who is died, right? It can be, for example, we all are tax consultant, right? So it can be like any of your client, maybe grandfather, grandmother, father, mother, or maybe any descendant has died, and his or her property is now being transferred to your client. So your client has inherited those property from those descendants, right? So for such kind of property, what should be the value in the books of your client? So that is the question here, right? The fair market value on the date of death, or the alternative fair market value 6 months after the death, right? So two things, like there are three scenarios, we'll be discussing that. But first you need to keep in mind fair market value on the date of death of the descendant, or the alternative fair market value 6 months after the death, right? If the fair market value is lower, that means what IRS is saying, take that position which is more beneficial to you, right? As simple as that. the position at which is more beneficial to taxpayer, taxpayer can opt that position. Taxpayer can opt the position to consider the fair market value on the date of death or the fair market value 6 months after the date of death, whichever is lower, right? Result into lower estate tax liability. So it will result into lower estate tax liability on the taxpayer. Clear, everyone? So far it is clear. First line. If alternative fair market value option is chosen, second line I'm discussing, if alternative fair market value option is chosen and property is sold before the 6 month, right? So we'll be taking few example also, but first understand the theoretical part. If alternative fair market value option is chosen and the property is sold 6 month before 6 month, then lower of the sales price or the fair market value on the date of death is considered as fair market value of asset. Why? If the property is sold before 6 months, then why will you be taking after 6 month fair market value, right? There is no point because property has already sold. So let's go through this example or illustration which I have mentioned here. Let's assume on 1st January, the relative of your client has died, right? On 1st January, relative of your client has died and he or she has received the property or inherited the property from descendant, right? So at that point of time, let's assume the fair market value of the asset which your client has inherited is $1,000, right? Second is on 31st March, which is before the completion of 6 months, that descendant, the recipient, the inherited of property has sold that property, right? The first two scenario when there is no sale, third and fourth scenario when the sale is at $800 or sale is at $1,200, right? And after 6 months, of the death, which is 30th June, the fair market value in scenario 1 is $900, scenario 2 $1,100, scenario 3 $900, and scenario 4 $900. So in all these four scenarios, we need to identify what should be the fair market value I'll be considering for the calculation or for my books of accounts. Now let's look at first scenario. The date of death is are you guys here with me?
1st January.
1st January, right? And the 1st January is the date of death and the fair market value is $1,000.
$1,000.
Right? And there is no sale in between. And after 6 months, the fair market value is $900. Right? So in this case of scenario, what will be the fair market value you should be considering as the basis of asset? The lower of the fair market value on the date of death or alternative date, right? So which one is lower?
900.
$900, right? Everyone agree?
Yes.
Second scenario, when at the date of death, fair market value is $1,000 or at the alternative date, fair market value is $1,100. So which one is lower?
100.
$1,000, right? So you'll be considering the value of asset $1,000 in scenario 2. Third scenario, they are saying at the date of sale, fair market value was $800 and on alternate date, the fair market value is $900, but the asset has been sold before 6 months at $800. So what should be the basis of asset? Right? The basis of asset should be lower of fair market value on the date of death or the sales price, right? So what is lower, sales price or the fair market value on the date of death?
Sales price.
Right, which is $800, right? Last scenario, when fair market value on the date of death is $1,000 and the sales before 6 months has been made for $1,200 and the fair market value on alternate date is $900. So what should be the fair market value?
1,000.
Why?
Because
Lower of,
that's lower of two.
yeah, lower of fair market value on the date of death or sales price. Clear, everyone?
Yes.
Yes.
Next is gift property. So basis will be lower of donor basis plus gift tax or fair market value on the date of gift. So gift, for example, your client has received a property as a gift from their parents, right? Let's assume his parents has multiple house and the parent has given to the son one house, and the house which his parents has purchased, let's assume 10 years ago, for $50,000, right? Maybe I would say, like, write down this example so that may help. So for example, Mr. X has received, just note down an example, I would say Mr. X has received a house as gift from his parents, Mr. A. Gift from his father, Mr. A, in 2023. Right? Mr. A has purchased that house in 2003 for $50,000. Right? Mr. A has purchased that house in 2003 at $50,000. In 2023, the fair market value of the house is $500,000. In 2023, the fair market value of the house is $500,000, and a gift tax of 1% on fair market value is applicable. A gift tax of 1% on fair market value is applicable. So what will be the basis of asset in the hand of Mr. X? What will be the basis of asset in the hand of Mr. X? Right? So the first point is, what is the basis of asset in the hand of parents? In the hand of father? $50,000? Yes? No? What is the basis of asset in the hand of father? $50,000?
Yes.
Are you guys with me? Right?
Yes.
Plus the gift tax. How much is gift tax? 1% of $500,000. How much is it?
5,000.
$5,000.
Hmm.
Right? So the donor basis plus the gift tax is equal to $55,000. Clear?
Right.
Or the fair market value at the date of gift, which is $500,000, whichever is lower. So which one is lower?
500,000.
55,000.
55,000. Sorry.
Right? Clear, everyone?
Yes.
Right? So that is how you need to calculate the basis of property when it has been gifted, right? When it is received as a gift. Next is personal property converted to income production. Here again, like most of the Indian students get confused. So earlier we have studied there are two types of property. One is real property and second is personal property, right?
Yes.
There we have studied like the personal property is all movable property used for trade and businesses, right?
Right.
Sir,
That
just
is
one
what
thing.
we have.
Sir, one question.
Hmm.
In the above case, if the fair market value is less than 50,000,
Then whichever is lower. So if fair market value is $40,000, then you'll go with $40,000 as a basis.
okay,
Hmm?
fine. Yeah.
Yeah. Any other question on gift property before we jump on to next one? Pooja, Prakash,
No,
Hakimuddin,
sir.
right? Everyone okay? Okay.
Yeah.
So point number F is personal property converted to income production. So here most of the Indian students get confused because earlier we have studied personal property are movable property used for trade or business. Then what is this personal property, right? The terminology used in both the cases is same, fortunately or unfortunately, right? But when you are looking at the question, you need to understand the sense of the question. Whether, like here in point F, they are saying about personal property, which is not from the business property, like your personal car, right? So you have a personal car which you are not using for business purpose, but now, for example, like earlier, your client or yourself was in employment and you have a car. Now you have started your own business, right? And now you have converted that car for a use of trade or business, right? Let's assume like your client have started Uber, Ola, right? And now he or she has started using the car for business purpose, right? So this is what they are talking about in point number F, right? It is really confusing. You need to be carefully understand the intention, or you can say the sense of the question, which type of personal property they are talking about, because the nomenclature for both is same, personal property, right? So you have to be more conscious and more careful when you are reading the question. So which type of personal property the question is asking. If the sense is movable, trade and business property, then you'll be using above what you have studied. But if the question is giving you sense that it is your own personal property which you have not used for the business purpose earlier, then that is given a separate treatment, right? So here in point F, we'll be discussing about personal property which was earlier not used for trade or business, right? The point number F says personal property converted to income production. That means converted to business property. Then when you are converting it to the business property, that means you need to charge depreciation for that, right? And
Right.
if you have to charge the depreciation, then there should be some basis of that asset which you need to recognize in your books. right? So the basis of asset will be lower of adjusted basis of asset minus allowable depreciation for the period in use, or fair market value, whichever is lower. So let's understand adjusted basis minus allowable depreciation. For example, you from earlier years, let's assume in 2020 you are in job, right? 21, 22 also you are in job, and in 2020 you have purchased a car, right? And now in 2023 you have started your business, right? And that car now you are using only for business purpose, right? So as you are using that car for business purpose, you definitely look for depreciation claim, right? So in that case of scenario, what should be the basis of asset at which you should be claiming the depreciation in 2023? So that is the question. That is the call of this question. So for example, if you purchase a car in 2020 and now in 23 you are using for business purpose, so what could have been the depreciation if from 2020 you have started this using for business purpose? So that you need to reduce to reach at the adjusted basis of asset for which you can claim current year depreciation. Let's assume, like just for the simplicity of example, the car has a life of 10 years and you are using straight line method of depreciation. And originally you have purchased the car for $100,000, right? So in 2020 you have paid $100,000 and you have purchased a car, right? And the car has a life of 10 years. That means ideally the depreciation on SLM basis will be $10,000 for each year, right? So for 2020, 2021 and 2022, so 3 years you used it for personal purpose, but in 23 you have started using it for business purpose. So in 23 the basis of asset will be $100,000 minus 10,000 for 2020, 10,000 for 21, 10,000 for 22. So remaining $70,000 is the adjusted basis of asset. Or in 2023, if the fair market value is 80,000, let's assume, then you'll be considering lower of these two, 70,000 or 80,000, whichever is lower. That means 70,000 will go into your asset. If the fair market value is $60,000, right? But adjusted basis is $70,000, then $60,000 fair market value should be considered as basis of asset. Like normally, all of you, I'm sure, have experienced that initial few year car depreciation is more higher, right? The fair market value will go significantly down. In India also you might have experienced. So if you have purchased a car in 2020 for $100,000 and you wanted to sell in 2023, it may go for a sale in $50,000 to $60,000, right? Make sense?
Right.
Right. So the fair market value will be generally in case of car would be lower than the adjusted basis. Make sense? Same is the case with computers, laptops, and other machineries as well possible, right? But this is how you need to calculate the basis of asset when you are converting your personal asset to business assets. Make sense?
Right.
G point is property received as a compensation of service. That means when you are receiving any property as a compensation, right? Nowadays, like most of the company provide car, shares, ESOPs, right, to the employees as well. Yeah, Manoj sir, you have any question?
So actually, I want to understand, is there any definition of personal asset in the US law? Like in India, we have two.
Sorry, you went on mute, Manoj. Say that again.
Hello, oh, can you hear me?
Yeah, now.
Hello.
Yes, please say again.
So I'm asking, is there any definition of personal asset in US law? Because see, there's a personal property and there's a personal assets. Both seems confusing.
Yes.
Because personal property falls under the property which is movable and but used for business. Then what
Yes.
is personal asset?
Yeah. So it's like more of terminology. That is the reason I specifically, like ask you to underline and identify. So this may be confusing for you because we are not exposed to the language the American generally speak. That is the reason, like in class, I'm identifying those area which can be painful for you to understand. Right? Personal property definition is there, which we have discussed above, but this personal property is not defined anywhere. It is the
So
way
there is no
this
definition of personal assets.
No. The real asset and personal asset definition which we have studied above, that is there in tax law, but this personal asset which belongs to themselves personally, not used for business purpose, that is not defined in tax law.
Got it. Like in India, we have defined that our personal the ornaments, etc., is not like a capital assets. They haven't specifically defined in the law that these are not the capital assets and these are the personal assets.
Yes.
So in US, so what is defined is okay. What is not defined is doesn't fall anywhere.
Yes. Yeah, but here like the only like real and personal property has been defined, but this personal property, what they are saying is normally how Americans speak basically. So that is, unsaid rule, I would say, or, generally in India also, if you see industry practice or trade practice, so it can say the communication practice, I would say they are using. Right. So that is the benefit of classes. Like I'll share with my experiences the differences or the area which can be painful for you to understand independently. Right. Next one is property received as a compensation of service. So compensation of service can be employment, can be professional service, right? As a compensation, like people provide ESOPs. Sometimes, like most of the company, they provide car, mobiles, right? Other accessories to the senior executive members, right? So those are actually is part of their compensation. So the basis of the property, for example, if you are a CEO or CFO at any organization and the company has provided you the BMW car as your bonus, right? In that case of scenario, what should be the value of BMW car in your books, right? For example, in future, you wanted to start your own business, so you may have the value of that asset in your book, right? So the fair market value when you have received that car, that will be the basis of asset for you. Make sense? Next is property transfer to control in exchange of its stock. So when you are transferring any property so that you can take ownership of any particular company, right? In that case of scenario, the basis of stock received by the company, that is book value of the property exchange plus any gain on property minus if any cash received minus any other property received, and basis of the property which you have acquired, that is the book value of the transferor who has given you the property plus any gain recognized by the company minus or company that is investing or transferor on the exchange. So that should be the value of property. Transfer of control here is more than 80% of the voting right. And last one is taxable exchange. So in case of taxable exchange, basis is always be fair market value. So we will be covering the calculation of basis for the following in detail. The first one is tax-free exchange, second is involuntary conversion, third is sale of personal resident, and the fourth one is wash sale. So that also we'll be discussing in detail because these are additional items relating to the basis of asset. Second topic over here is the holding period of asset. So holding period, like we were discussing, is generally defined whether the asset or gain or loss need to be considered as short term or long term, that is 12-month period. So long term, which is 12 months or more, resulting into long term capital gain. Short term, if it is less than 12 months, resulting into short term capital gain or loss. Note over here is inherited property disposal of within 1 year shall be considered to have been held for more than 1 year. So here is an exception to the general rule. So when you have inherited any property and that property you are selling, in that case of scenario, your holding period plus from the descendant holding period need to be clubbed together and identify if it is more than 12 months, it results into long term. If it is less than 12 months, it results into short term. Second is if any security which is a capital asset become worthless during the taxable year, book the losses on the last day of the year. So if you remember like earlier, an example which we have gone through, $700 security become worthless. So this loss, when the security is become worthless, only in that case of scenario, you need to record the loss on the last day of the year. Right? So this is about holding period. There's one small example, which is, for example, investment in XYZ company on 1st January 2001. 1,000 share of $100 each, that is $100,000. XYZ company become bankrupt in year 4 in 2005 and the value of share become worthless. Then book the long-term capital loss of $100,000 on 31st December 2005. Here one more thing, we use the format DDMMYY, right? Whereas for all the CPA examination or all the in future communication with US, just keep in mind they use MMDDYY. So they consider month, date and year. So always be wherever you will see in the entire book, it will be coming month first, then date, then year. Right? Let's do quick 2 questions together. First one is Conquer purchased Flora stock in 2016 and sold it in 2023. So is it short term or long term?
Long term.
Long term.
In 2023, he also traded in a copy machine that he had been using in his business since 2018 for new model. That means he has given old copier and purchased a new copier. On December 15, 2023, he inherited 35 share of Funa Laboratories stock. What is the holding period of these property? So first property we all discussed long term. Second was the copier. The copier she has purchased in 2018 and in 23 she is exchanging. So that copier is long term or short term? Copier is long term or short term?
Long term.
Long term.
Right? And the third one is inherited property, that is also long term. So option 1, all short term. Second, Flora stock long term, copy machine and Funa stock short term. Third is Flora and Funa stock long term and copy machine short term, or all long term. Which option is correct?
All long term.
All long
All
term.
long term.
Right? Next question, last question of the day. Dove Corporation began operating a hardware store in current year after constructing a building at a total cost of $100,000 on a land previously acquired for $50,000. In current year, the land had a fair market value of $60,000 and Dove paid real estate tax of $5,000 in current year. What is the total depreciable basis of Dove business property? Have you understood the question? Anyone can explain me what is the call of the question?
The total value will be
Yes, yes. So what is the call of the question? What is the total depreciable basis of Dove business property? How much is the cost of building?
100,000.
$100,000.
And how much is the cost of land?
50,000. In the
50,000
current year,
plus 50,000 plus
5,000 tax.
Or fair market value, whichever is lower. So how much is total? 55,000,
Yes. Yes.
right? So the total asset, depreciable asset, will be how much?
155. 155.
155.
Is land a depreciable asset?
No.
Oh.
So that kind of distractor you can expect in exam, right? So this is it for today, and we'll continue from the basis of stock after split and dividend from tomorrow class, right? So I think you all have these notes with you. Request you all to please go through the notes. If you still have any question, so tomorrow before starting the class, we'll take up your question and then we'll continue with the new topics, right?
सर मेरे पास नोट्स नहीं है
It's in group, maybe